Happy Tuesday, everybody. Welcome to another episode of Market Update, where we discuss leading economic and financial developments in Europe, Asia, and North America. My name is Tony. Let's jump in. And first up, Russia's second largest bank, VTB Bank PJSC, is grappling with a steep and sustained collapse in profits from its core lending operations, showing the mounting pressure on the country's banking sector from President Vladimir Putin's war in Ukraine. According to the first half of 2025 results released in the last few days, VTB's net interest income, the gap between what a bank earns on loans and pays in deposits, plunged 49% year on year to $1.9 billion. The drop marks a more than 60% fall from the end of 2023 and is rare among large global lenders. And these are the official numbers. The actual situation may be much worse. While the bank still posted a net profit of $3.5 billion for the period, that figure was buoyed by volatile gains from financial trading rather than steady interest income. Analysts warn that such income streams offer limited sustainability. Last month, some senior VTB managers reportedly privately voiced concern that headline figures mask deeper vulnerabilities, particularly in the corporate loan portfolio, where war-related debt is difficult to assess due to data restrictions. Public metrics show a modest but notable deterioration in credit quality too. VTB's non-performing loan ratio climbed officially to 4.1% in June, a 4 percentage point higher than a year earlier, with retail loan delinquencies rising sharply. Non-payment from individuals jumped 32% year to date, and mortgage defaults are increasing too. The bank's cost of risk, a key gauge of potential credit losses, rose across both retail and corporate segments. The pressure comes as Russia's state-owned banks play a critical role in financing the war effort. Moscow has directed lenders to extend preferential credit to defense-linked industries, while sweeping sanctions, wartime spending, and inflationary pressures have tightened liquidity and pushed interest rates to record highs. These factors have strained borrowers' repayment capacity, driving restructurings and obscuring the true scale of problem loans. Capital buffers at VTB remain historically thin. In late 2024, the core capital adequacy ratio dipped close to the regulatory minimum, sparking speculation it might require recapitalization from the state. While the ratio has since stabilized officially, reports suggest that several systemically important banks, including VTB, the second biggest in Russia, have privately discussed potential bailout needs. This would indicate the banks are on the verge or already in the process of collapse, requiring state intervention. The Russian central bank has publicly downplayed the risk of a systemic banking crisis, citing 8 trillion rubles in capital reserves and pledging to release capital buffers if needed. However, outside experts remain skeptical, and there's a Lofsgaard of the Stockholm Institute of Transition Economics noted that it is, quote, hard to believe, end quote, a bank's profits can sustainably grow when its net interest income has collapsed so dramatically. We will continue keeping an eye on this space. Next up, we move to North America. After more than 5 years with pandemic-era relief, in recent months, the U.S. federal government resumed collections on defaulted student loans, a move that could have far-reaching effects on both individual households and the wider economy. With $1.6 trillion in outstanding federal student debt, incredibly, only about 38% of borrowers are current on payments, while millions are delinquent or in default. The Department of Education estimates that nearly a quarter of the loan portfolio could soon be in default as overdue balances mount. The pandemic payment pause, coupled with multiple extensions and failed attempts at mass forgiveness, has left many borrowers disconnected from the debt. Some have gone years without making a payment, while others have prioritized essentials like rent, groceries, and transportation over their loan bills. As payments restart, the consequences are becoming tangible. Declining credit scores, renewed credit reporting, and, starting later this summer, wage garnishment for those in default. For borrowers, the shift is happening against a backdrop of broader economic uncertainty. Wage garnishment and other collection measures risk reducing consumer spending by as much as $63 billion annually, according to a recent report by US-based Bloomberg Economics. That hit comes as the economy is already navigating the strains of ongoing trade tensions and tariff-driven cost pressures. The government's stance is firm. Education officials say resuming collections protects taxpayers from shouldering the cost of unpaid loans, and defaulting borrowers will be urged to enter repayment programs, sign up for income-driven plans, or pursue loan rehabilitation. Those who fail to act could see deductions from paychecks, tax refunds withheld, or even social security benefits reduced. Yet the system's reactivation after years of leniency presents behavioral and logistical challenges. Many borrowers, particularly younger ones who have never made a payment before, have little experience with the mechanics of repayment. Others remain skeptical about the system's fairness following the Biden administration's blocked forgiveness efforts, fueling resistance to compliance. Of course, those who have paid for their student loans or those who did not borrow so they could go to university would likely find these complaints unconvincing, saying that if you borrow the money, you should repay it. This debate about student loans has spiraled into a larger political debate in the United States. Meanwhile, credit deterioration is already widespread. The New York Federal Reserve estimates that millions will see score drops of 100 points or more this year, increasing the cost of future borrowing. For those not seeking mortgages or car loans, the impact may feel distant until wage garnishment or other direct collections begin. Economists warn that the combination of repayment resumption, trade-related economic volatility, and elevated living costs could pressure household budgets and slow consumption. While the job market remains relatively strong, the abrupt end to forbearance has injected new financial strain into millions of households. The restart of collections marks not just a fiscal policy shift, but a test of how borrowers and the economy will absorb the sudden return to a once dormant obligation, one that many had pushed to the back of their mind. Now, if you want to be on top of the most up-to-date analysis on the biggest developments from the most important markets around the world, consider subscribing to Market Update. Hit the bell notification icon and you will be. And if you're getting some value from today's episode, don't forget to hit the like button and consider sharing with someone who you think would also get some value. And finally for today, we end in Asia. Singapore has raised its economic growth forecast for 2025 after a stronger than expected performance in the first half of the year, driven by accelerated exports ahead of US tariffs and an easing in global trade tensions. The Ministry of Trade and Industry, MTI, now expects gross domestic product to grow between 1.5 and 2.5% year on year, up from its previous 0 to 2% projection made in May. The upgrade follows the publication of Q2 data today, Tuesday, which showed a second quarter GDP expansion of 4.4%. On a seasonally adjusted basis, the economy grew 1.4% from the previous quarter, avoiding a technical recession. MTI's permanent secretary attributed the robust first half performance to front-loading by businesses ahead of US President Donald Trump's latest tariff measures, as well as progress in US-China trade talks. However, he cautioned that uncertainties still cloud the outlook, making it premature to rule out economic setbacks later in the year. The Singapore dollar edged up 0.1% against the US dollar in morning trade. Year to date, the currency has gained more than 6% against the greenback, and the benchmark index is up nearly 12%. While first half momentum was strong, MTI warned that growth will likely slow in the second half. Manufacturing, which benefited from accelerated shipments in electronics and pharmaceuticals, is expected to moderate as tariffs dampen demand in other markets. The wholesale trade, transport and storage sectors may also face headwinds as front-loading wanes and global cargo demand eases. The Monetary Authority of Singapore, MAS, left policy unchanged at its July meeting, following earlier easings in January and April. Deputy Managing Director Edward Robinson said the central bank's, quote, gradualist approach, end quote, allows for timely adjustments in quarterly reviews. The MAS is set to make its next policy decision by the 14th of October. Analysts note that Singapore's relatively low reciprocal tariff rate of 10% shields it compared with some Southeast Asian peers, though risks remain if the US raises sector-specific levies on key exports such as semiconductors or pharmaceuticals. Kieran Calder, head of Asia Equity Research at BP, said he believes the world has, quote, passed peak tariff uncertainty, end quote, adding that small open economies like Singapore are well positioned to navigate current trade conditions. MTI said it will continue to monitor developments and adjust its GDP forecast if needed, noting that flexibility and resilience remains critical for sustaining growth in an increasingly volatile global environment. Okay, that is today's episode of Market Update. Thank you so much, everybody, for watching. Have a good Tuesday, and I will see you for another episode tomorrow.